Arizona is home to lots of high-tech companies. Intel, Honeywell, Boeing, just to name a few. Many of the employees that work there have long-time careers and are retiring with company stock in their 401k plans. What they may not know is there is a special tax loophole that can potentially save them big bucks when they retire. I personally am horrified when I hear the statistics on how much money in 401k plans is invested in employer stock. A recent study found that 53% of employees who have the opportunity to invest in their company's stock do so. Nearly 7% have more than 80% of their 401k assets invested in their employer stock. The biggest problem with this is not only is your current financial success tied to one company, but your retirement as well. You really do have all of your eggs in one basket. The results can be devastating. Look at United Airlines, US Airways, or General Motors. Not only did employees lose their jobs when the company went under, they also lost their retirement savings. Probably the most egregious example was Enron, in which over 57% of the employees' 401k assets were invested in Enron stock, and the employees watched as it fell 98.8% in value during 2001. Their lives were destroyed. But what if you're one of the lucky ones? You have employer stock in your 401k and it's done really well. If you're close to retirement, there is a tax break that you should be aware of. It has to do with special treatment of stock distributions from a 401k plan. Here's an example of how it works. Larry worked at Intel for many years. He had stock in his 401k plan that he originally purchased for $10,000 and it's now worth $100,000. He has two options when he retires.
Under Plan A, he can perform a cash transfer of $100,000 from his 401k plan directly to an IRA account. After the transfer, the value in the IRA account is $100,000. There is no tax on the transfer, but as he takes withdrawals, Larry is taxed at ordinary income tax rates for every dollar that he withdraws. Plan B is the option to transfer the stock to a non-IRA account. At the time of the transfer, the $10,000 original purchase price is considered a taxable distribution reportable on his current tax return. The planning opportunity is that after 1 year, he can then sell the stock and pay tax at capital gains rates on the $90,000 appreciation. This two-step process can potentially reduce his tax liability significantly.
Naturally, determining if this strategy will work for you depends on many factors. The cost of the company stock in the plan, the current value of the stock, your tax bracket now and when you retire, and finally how many years you have until retirement. Since I'm a CPA and can therefore offer tax advice as well as investment advice, I can help clients determine the best strategy in their unique circumstances. If you would like for me to help you, don't hesitate to contact me at 480-503-0050.
This has been a Loki production.